Welcome to Woods of Stardon. This is CH. I will be covering the Aberdeen Short-Dated Enhanced Income Fund in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the Lion Global Short Duration Bond Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. Aberdeen was originally established in 1983 as Aberdeen Asset Management, a Scottish boutique fund manager based in Edinburgh, UK. It was listed in the London Stock Exchange since 1991 and grew quickly to become one of the leading listed fund providers in Europe. Aberdeen is also a pioneer in Asia-Pacific markets, having invested since 1985, and was quite well known in the region for its Asia products back in those days. In 2017, Aberdeen merged with Standard Life, a UK-based insurance and asset management business, and started its years of confusing branding mishaps. The new company was renamed Standard Life Aberdeen, while the asset management was named Aberdeen Standard Investments. The entity didn't last too long, with the Standard Life insurance business sold in 2018 and the Standard Life branding sold in 2021, both to Phoenix Group, another UK insurance company. Aberdeen then continued its branding mishaps by renaming itself to Abrdn, pronounced the same way but spelt without all the E's. Aberdeen finally came to its senses and decided to rebrand in March 2025 back to Aberdeen, with the parent entity as Aberdeen Group and the asset management arm as Aberdeen Investments. Renaming all its products will probably take time though, which is why this fund is still having the weird Abrdn in its name currently. Aberdeen today manages €447 billion worth of assets for the wide spectrum of clients across 80 countries. Its core competencies are in equities, credit, and real assets solutions, though it has been trying to grow other offering categories. The Aberdeen Short-Dated Enhanced Income Fund covered in this video should fall under the credit category. The Aberdeen Short-Dated Enhanced Income Fund is a sub-fund under the Aberdeen SICAV 1 fund family. The fund family is set up as a Luxembourg SICAV company structure and is UCITS qualified. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. Aberdeen isn't great when it comes to fund manager information. The Aberdeen Short-Dated Enhanced Income Fund fact sheet lists Mark Monroe as the only fund manager. A check in Morningstar, however, found that while Mark is the manager since the fund inception in 2023, there is also Joyce Bing, who replaced Thomas Drisner about a year ago. I can't seem to find the bios of Mark and Joyce in the Aberdeen website or Morningstar or Google, so we unfortunately do not know their credentials and experiences. The Aberdeen Short-Dated Enhanced Income Fund webpage and fact sheet states the same investment objective, which is to achieve a combination of income and growth, whilst also aiming to provide liquidity and avoid loss of capital by investing in bonds with maturity up to 5 years. More specifically, the fund aims to achieve a yield in excess of the Bloomberg Global Corporate Aggregate 1 to 3 year index over rolling 3-year periods. There's quite a lot of things the fund is trying to achieve in this short objective paragraph, so let's try to set our expectations properly. The main objective of the fund is probably the second paragraph, that is to generate a higher yield than the stated index. This means that capital growth is probably a good-to-have secondary objective. The objective also mentions about providing liquidity. I'm not sure what this means, as nearly all mutual funds are daily traded, but we'll see if we can find more information later. There is also a mention about avoiding loss of capital. For a mutual fund that takes long-only market exposure, loss of capital is impossible to avoid. So what this really means is that the fund can at best reduce unnecessary losses, such as adjusting duration to reduce interest rate risk, or be prudent in the due diligence of bonds with higher risk. The short data in the fund name points to the maturity constraint that is max 5 years. It is interesting to note that the fund opted to compare against an index that has a max 3 years maturity constraint instead of finding one with 5 years. Logically speaking, it wouldn't be difficult for the fund to have a higher yield than the index, given the maturity differences. So this looks like a pretty easy objective to achieve. The prospectus provides further elaboration on the investment constraints of the fund. Here, it clarifies that the liquidity is simply a reference to the high-quality, short-dated nature of the portfolio. So this isn't really something different from most of the bond funds in the market. The fund's investable universe is quite broad, covering global, developed and emerging markets, corporate and government bonds. The fund is mandated to have minimum 70% invested in such bonds with maturity of max 5 years, meaning it has the flexibility of max 30% to invest in longer maturity bonds. That being said, the fund aims to maintain an average duration of 1 to 2 years for the portfolio. The fund is mandated to invest minimum 50% in investment-grade debt, while having a max 20% constraint on high-yield rated debt. I assume the remaining of the portfolio would be in cash equivalents if it's not filled up by the investment-grade debt. The high-yield debt serves to provide higher yield to the portfolio, but obviously comes with additional risks that the fund needs to manage well. In any case, the fund aims to maintain an average credit rating of single A-. The fund doesn't use FX as a returns contributor. The base currency of the fund is US dollars, and non-US dollar positions are typically hedged back to US dollars to minimize FX risk. That's all there is in the prospectus actually, which doesn't really give us any information on the investment process of the fund. Interestingly, the fund has a separate featured web page where there is a fund guide document that contains some additional information not found in the prospectus, such as max 30% subordinated bonds, max 20% in perpetual bonds, max 20% in non-US dollar bonds, minimum 10% in cash or T-bills, and minimum 15% in bonds with less than 1 year to maturity. Given these are not mentioned in the prospectus, I would consider them as not legal binding and therefore can be changed anytime by the fund. The featured webpage and fund guide does provide a nicely designed summary of the key selling points of the fund. Investors should note that the Why Invest section is talking about the asset class, not the fund. The fund-specific selling points aren't really out of the norm as well. Low duration, high credit rating, and liquidity comes from the asset class, and can be found in pretty much all other short maturity bond funds in the market. The main differentiator is therefore the enhanced income of what seems to be a pretty high payout yield, and our main task is to try find out if this is sustainable. The Aberdeen Short-Dated Enhanced Income Fund was incepted in July 2023, giving it slightly less than 3 years of track record currently. Fund AUM is over $740 million, which is a decent stable size. For portfolio breakdown data, the fund fact sheet contains a lot more details than the fund webpage, so we will refer to that. I'm also including here the Vanguard US Dollars Corporate 1 to 3 year Bond Usage ETF that tracks the Bloomberg Global Aggregate Corporate US Dollar 1 to 3 years Index for comparison purposes, as the fund stated in its objective to have a higher yield than this index. Looking at the country breakdown, we can see that the fund looks significantly different from the index, especially with just 32% US exposure compared to over 70% in the index. The other listed countries all have higher exposures than the index, and there is a large chunk of 31% in others that suggests the fund has a much broader country diversification. Morningstar provides further clarity on this, and we can see the fund looks to be highly diversified globally across both developed and emerging countries, especially with a fair share outside of US and Europe that is not seen in the index. Sector-wise, the two products use different classifications, so it is difficult to compare like for like. The fund does hold about 20% in government and quasi-sovereign bonds that wouldn't be found in the corporate-only index. Credit rating-wise, the differences are quite clear as well. The index is pure investment grade and is mainly in single A and triple B exposures. The fund, on the other hand, has about 14% high-yield rated exposures, and therefore tries to offset it with a much higher exposure in double A's. This leads to both having a single A- average credit rated portfolio, obtained through rather different constructs. There is no maturity breakdown in the fund fact sheet, so we will rely on Morningstar for this data. The fund has only about 44% of the portfolio with less than 3 years of maturity, although the Morningstar data doesn't tally to 100%. The missing portions might be perpetual bonds or cash equivalents that are not included in this table, so we can't really use this data to compare. The fund fact sheet also provides currency breakdown, although it doesn't say whether this data is before or after currency hedging is done within the portfolio. As per the prospectus, the fund is expected to hedge currency exposures to US dollars in normal circumstances. Top 10 holdings is provided in the fact sheet, although this is not too useful typically for bond funds that have many positions in the portfolio. In this case, the fund currently has over 220 holdings, and this number will grow in accordance to the fund AUM. The fund fact sheet indicates the portfolio yield to maturity is 4.23%, which is lower than the 5% payout yield mentioned in the fund guide document, but we will go through the distribution data later. Morningstar indicates the portfolio modified duration is 1.45, which will be within the intended levels stated in the prospectus. The Aberdeen short-dated enhanced income fund has quite a list of share classes, although most of them are not registered and offered to the Singapore retail market. Besides the base currency US dollar classes and Sing dollar hedge classes, the fund offers Euro, Hong Kong dollars, and Sterling classes. Non-US dollar classes are typically currency hedged. Normal retail class is A class. The US dollar classes were created at fund inception in 2023, while the Sing dollar hedge classes were created only in late 2024. Both currency classes come with accumulation as well as monthly distribution versions. I'll go through the distribution details in a while. The retail A class has 0.5% management fees. Adding other expenses gives a total expense ratio or TER of 0.67%. This is slightly on the high side for short maturity bond strategies. The HSBC Ultra Short Duration Bond Fund that I covered previously has only 0.55% TER for its retail class. Up to 60% of the management fee can be paid by Aberdeen to distributors as trailer fees. Distributors are also allowed to charge up to 5% subscription fee for the retail A class, although I think anything more than 1% for bond funds is excessive. Investors looking for a lower fee share class can try to find distributors that offer the X classes, that has no subscription fee and comes with a lower 0.42% TER. The fund currently does not have Sing dollar for X class though. The Aberdeen Short-Dated Enhanced Income Fund's distribution share classes has a naming convention with a gross MINCA that probably confuses many investors. Aberdeen tries to explain this with a distribution guide document. According to the document, Aberdeen's funds typically have 4 different distribution types. This fund offers only the gross distribution type, whereby the distribution amount includes actual income generated in the portfolio, but not investment capital gains. Additionally, all costs such as TER and currency hedging costs are paid from capital instead of distribution. The document is unfortunately incomplete and doesn't explain the remaining naming convention, so we will still have to refer to the prospectus for details. The MINC is more easy to interpret, which basically means monthly distribution frequency. The A after that refer to accelerated income, which according to the prospectus description seem to mean that the fund can fast forward the distribution declaration and payout instead of sticking to the usual monthly schedule. I don't know why there is a need to do this, and I haven't really seen this additional clause in other Aberdeen funds. I can't seem to find distribution history for the fund in the Aberdeen website, except for the fund guide document that nicely provides a table for distribution yields in 2025 for both the US dollar and Sing dollar hedge share classes. Combining this with the distribution payout data in Morningstar, we can see that the fund does not have a smoothened payout policy, as both the payout yield and payout amounts fluctuate every month. There does seem to be an effort to maintain the payout yield of the US dollar class at around the 5% levels, although this is probably the result of the underlying coupon yield of the portfolio being actively managed. Investors who are relying on this fund for income generation should take note of this. Things look a bit more complicated for the Sing dollar hedge share class. The NAV, payout amounts, and payout yields all have been on a declining trend. In particular, the payout yield dropped from 5.47% at the start of 2025 to 4.20% at the end of 2025. Relative to the more stable NAV of the US dollar class, the NAV of the Sing dollar hedge class has declined mainly due to the high currency hedging costs in the past year or two. The distribution amounts might be affected by the unfavorable effects as they are being converted to Sing dollar to pay out, leading to an overall worse payout yield situation. Let's use Morningstar charts to see this more clearly. Here is the US dollar distribution share class since incepting in 2023, where we can see the NAV has basically been flat with a little bit of volatility, while nearly all the returns are in the form of distribution payout over this period. The Sing dollar distribution share class shows a rather different picture. Since incepting in 2024, the NAV has been consistently declining due to the currency hedging costs. The distribution payout looks less attractive as well, leading to a relatively weaker performance and income experience for Sing dollar investors. The Aberdeen Short-Dated Enhanced Income Fund performance data is found in the fund fact sheet in table format. The fund has less than 3 years worth of track record, so there really isn't much data to review. What can be seen is that the fund so far seems to have underperformed the benchmark very slightly. This is a bit surprising because the fund has a much broader investment mandate, whereas the benchmark is pure developed markets investment grade corporate bonds only, with about 70% US exposure. So I would have thought the fund can find more opportunities to invest into. Here is a Morningstar chart comparing the fund versus the Vanguard US dollar corporate 1 to 3 year bond UCITS ETF that tracks the same benchmark index, which we used when we went through the portfolio details earlier. Both the fund and the ETF have performed near identical since the fund's inception in 2023, except that the ETF exhibited slightly higher volatility at times. Again, this is surprising as the fund is expected to be able to generate better performance. Otherwise, investors might as well go for the ETF. I covered the HSBC Ultra Short Duration Bond Fund previously that has a lower duration and maturity objective. This translates to a slightly lower return solution in exchange for lower volatility and drawdown. Investors who need the stability and capital preservation may prefer the HSBC fund instead. This is especially relevant during market uncertainties as we are going through right now, whereby the Aberdeen fund has corrected slightly in line with the Vanguard ETF, while the HSBC fund seems to be holding up quite well so far. Let's take a look at the Sing Dollar Hedge share class next. Sing Dollar investors will have a hard time getting convinced to go for this fund, as the very high currency hedging cost of around 3% per annum eats up more than half of the returns of the fund, making the Sing Dollar Hedge share class unattractive returns-wise. While this is not a fund-specific problem and impacts all other funds in the market, this problem is particularly outstanding with a low expected return solution like this one. As a result, the short duration Sing Dollar bond funds that I have covered previously have all outperformed the Aberdeen fund in Sing Dollar terms, making them more viable for Sing Dollar investors currently. The same applies for US dollar investors as well, whereby the US dollar hedge share classes of the short duration Sing Dollar bond funds have actually performed very similar and even slightly better than the Aberdeen fund, especially in the last 1 year. Of course, the market coverage and exposures are not the same, but this does give US dollar investors some food for thought on the choices available. With that, let's summarize our findings. Aberdeen is a UK-based fund provider and had decent business and brand recognition in Asia before 2017, but unfortunately went through some challenging business decisions in the last decade. It currently manages about €447 billion worth of assets globally. The Aberdeen Short-Dated Enhanced Income Fund is essentially a global short-duration bond fund that has some flexibility on geographic coverage and limited high-yield exposures in order to try generate higher income or distribution yield. While the investment constraints are clearly stated, there is no information available on the investment strategy and process of how the bonds are selected and how the portfolio is constructed. This limits the understanding of the fund by investors. The fund has a short track record of less than 3 years, making it difficult to assess how the fund will perform across different market conditions. That being said, Aberdeen has managed to build up the fund AUM to over $700 million, which is a decent size. The portfolio construct looks quite well diversified, be it geographic regions, sector, or credit rating wise. The fund doesn't have a smoothened payout distribution policy, so the distribution amounts and percentage fluctuate every month. This may be a concern for investors who are looking for a consistent income stream. Performance is the biggest issue for the fund. While the portfolio looks nicely designed, it has not translated to outperformance versus the benchmark index. Investors can simply opt for a passive ETF to get a near identical total return. The Sing Dollar Hedge share class is currently unattractive from a performance perspective, as the high currency hedging cost of around 3% per annum is eating away a significant portion of the fund's returns, which is low to begin with given the nature of the fund strategy. In conclusion, the lack of information on the investment process makes it hard to give a better assessment on the fund. Performance in particular is a concern, as the fund has not been able to exhibit a clear outperformance versus the benchmark index, making it less compelling as investors can easily go for ETFs tracking the index instead. This concludes my absolutely biased comments on the Aberdeen Short-Dated Enhanced Income Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.